today, we are truly privileged to have on one of the best known, and I think one of the best educators and financial advisors and all-around personalities in foreign exchange and financial advice of almost any type, Rob Booker, also an old acquaintance and friend of mine. Rob, welcome and thank you very much for coming.
I'm so happy to be here, Joseph. It's nice to see you again.
You know, although the idea of coming these days with our wonderful communications is a bit of a misnomer, still it is nice to have you here.
It's great to be here.
It is kind of cool. It is fun, isn't it? We get to do this, continue to have fun. You know, you and I have largely kind of career-wise grown up with the internet.
Yeah.
The market is and has been full of advisors, educators, system traders, trading fads come and go, and you have remained over the years one of the most popular and respected educators and financial advisors in the business.
Well, it's unusual. Really kind of you to say. Thank you.
But I think it's true. What do you attribute this to? I have my ideas about why I think you've been so popular over the years, but what are your ideas? How do you view it? Because you have a very close and intelligent view of the market and traders.
Well, I really appreciate that. And I feel the same way about you, actually. I look at what you're doing and how long I've known you, and I've seen so many people come and go over the years. You know, they get into the business of education or trading or whatever it is, and they're gone. I feel really lucky to have had my association with traders for as long as I have. And I truly love, as I think you do as well, I love hanging out with and talking to traders. And if you're still doing a show like this after all these years, you have to, it's got to be more than just a love of the markets. It's got to be a love of the people that you're talking with. I think that for anybody that ever thinks about getting into the business of speaking on a camera or into a microphone about the market, I think one thing to remember is that you have to, and I'm not ashamed to say this at all, Joseph, that you have to be able to entertain people long enough to educate them, that this material is not interesting enough on its own. It's just, really not. It gets old really quickly. There's only so many trend lines you can draw or indicators that you can invent. But most of this stuff has been done already. And I don't have a super unique, special holy grail. I never have. And so I think, you know, the reason I've been around as long as I have is that I have enjoyed talking to traders, and I've tried to make it entertaining to the people who are listening.
And you're certainly good at that. I mean, whenever we don't go to shows anymore, and I think you probably still do, but you were always one of the most popular venues there. And there's a reason for that. You know, to many people who approach the markets, certainly to beginners, and more than a few people who've been around for a while, the market seems a bit of a mystery.
Right.
It's as if there was some sort of, you know, large creature underneath Wall Street and dictating the moves, and your job is to figure out what this creature is going to do. How do you convince people? One of the themes that I've always tried to use, especially when I'm talking to beginning traders, is to tell them that their analysis is an entry into everyone's analysis.
Okay.
That it gives them a way to view the market.
Right.
How do you go about doing that on a much wider scale the way you do? And how do you convince people of this?
I think the first thing that I've had to remember over the years is that I don't actually know more than anybody else. That I don't know, I might have a unique take on things, but I don't know more than anyone else. And now from time to time, Joseph, I have been under the impression that I know something special. And those are the times that I get, and those are the times that I get myself into so much trouble. Here's a story about that. Last year I was convinced that if Trump were elected, the US dollar would crash and gold would surge. And I was convinced that it would happen almost immediately. Well, it happened for like 11 minutes during the election, the night of the election. And I was totally wrong. But I'd never been more sure of myself about anything, well, at least for the last, 4 months before that. But I really thought I knew it. And it was a reminder again that the best thing that I can do is not necessarily be confident about one specific result that is absolutely guaranteed to happen, but rather have a plan and be open about having a plan, regardless of what happens, if it moves in either direction. And I could have made a lot of money off of the move if I had just admitted that I could have been wrong about that and planned something to go in the opposite direction and take advantage of this giant bull run that the dollar had right after Trump was elected.
And equities. You know, it's interesting because we plan for things that we're going to do, but what we're really planning in many cases is we're playing out our own hunches, our own approach, our own psychology. That's what would have made someone, myself as well, think the dollar's going to get hit. In fact, in retrospect, it looks very logical. Trump's essentially pro-business, however loony he may or may not be, and whoever you like his politics or not, he's essentially a businessman. And which has always been a standard view. Since we're on this topic, let's just take it a little further. We have, of course, tomorrow's election in the UK.
Right.
Now, I was sitting and blogging and writing the night of the US election, which was, from a market point of view, wonderful. There was volatility. It was fascinating. It was a really interesting evening, and I had a great time. There's a potential, I don't think as much, and when I tell people this, they get horrified. Because I live in Manhattan, and if I'm a guest at a dinner party and I say, oh, wasn't that election great? The immediate horror around the dinner table and my invitations plummet. That's what happens. That's okay.
Yeah.
And then I have to explain, no, that's not what I mean. Anyway, it's an agnostic view. Do you see any of the same, as you brought up, do you see any of the same potential for the UK election, because you have the same type of assumption set up here?
Yeah, I think the answer is no for me, but I want to explain. I think there's an interesting take on this, that from start to finish, from the surprise election result in the US to the surprise reaction that the financial markets had, I think that 90% of that was due to the fact that we had an unpredictable candidate, and that all the things that have happened, right at the election and after the election in the financial markets have been sort of a product of this fascination with the unpredictability of the candidate. I don't really see a candidate like that, or someone who's willing to communicate directly with voters or directly with the population in the UK. So it's almost like you have the potential for something like that to happen in the future, but I really don't see anybody taking the stage or getting enough of attraction on Twitter or anywhere else to really to surprise us when it comes to that result. I mean, the elections were called, right, because there was a foregone conclusion that the party would get an extra 5 years or whatever it is in the UK. And I think that even though maybe the race is tightened up a bit, the likelihood of a surprise is minimal. And even if there were a surprise, you're not going to get anybody that's even remotely close to the I want to be careful with my words here, with the crazy balls.
Which is really no way to put it. It's his approach, and I'm not going to dwell on politics at all.
Okay.
Really. His approach to governing is one that the United States and pretty much any other developed country that I can think of has never really experienced. The closest I can come to it, and I'm not a specialist in American history, was Andrew Jackson, and this parallel has been drawn many times before. It's not original.
Right.
The tool that people use, that people almost always approach the market with, and most educators use, and it's their product basically, is technical analysis.
Right.
This election is a perfect example of the question, and really the answer: is technical analysis, even brilliant technical analysis, enough to be a successful trader?
That is such a great question. I was just thinking about this yesterday when I was trading around the time of the two economic reports that came out in Australia. And, there's this sentiment amongst technical analysts. We like to believe that technicals precede fundamentals. And I'm sure you've heard this trope a thousand times. I have.
Being a fundamentalist, I tend to argue against it. I don't think
okay, exactly. And I think that those conversations take us away from what's important. And whenever I hear somebody say, well, the fundamentals drive the market, I don't know if you've ever had Jarrett Davis on your show. He's this guy in the UK, and it basically, he just repeats over and over that it's all about fundamentals and it's all about fundamentals. And I just want to punch him in the mouth. I'm sure he's a nice guy. And then I hear people say, well, the technicals always lead the fundamentals. And I just want to wrap my hands around the necks of those people, that if that were enough, then we'd all just be printing money, and our computers would be these ATM machines, and there'd just be this money flying out of it. That there's this other aspect of it that goes back to what you and I were talking about a moment ago, that longevity and survivability in the market is going to come from a willingness to be wrong first, but then do something about it. That if you combine the technicals and the fundamentals and you create a picture to the best of your ability about what's going to happen, there's still a 50% chance that on any given occasion, you're going to be totally wrong about it. And some other unknown is going to insert itself into the market, and, Uber is going to blow up, or North Korea is going to suddenly, there's always something that can come into the picture that's going to change, or a fat finger, technical situation can happen, and a giant candle can appear on the chart. So we're just moments away at any given time for being wrong. And I think that it's important to say, okay, I'm going to do 50% technical and fundamental, and then I'm going to do 75%, which is 125% of psychology and risk management. And in the end, that's going to make the most amount of difference anyway.
When I first went to Credit Suisse on the trading desk in the early 90s, I was straight out of graduate school and straight out of an English major, and I knew zip about trading or the markets. I showed up in a tweed jacket because my suit wasn't ready yet. This is true. And one of the hardest.
What's a tweed jacket? I got to look this up.
Tweed, nobody wears it anymore. It was probably out of style when I owned it.
Okay.
Something like people used, the British used to wear it's from Scotland, to shoot grouse on the moors or something like that. I don't know what I was doing, and I was living in Manhattan, and I had a tweed jacket. But one of the things that was hard to learn on the trading desk was you ask.
There it is.
It was worse. It was much worse than that, actually.
Okay, that's a nice looking jacket, actually. Okay,
it looks like it was woven out of burlap, and it was a very fancy jacket, but it was not appropriate. Anyway, it was very funny. Well, I was out. Trading desks in the late 80s, early 90s were largely guys from athletic backgrounds. That's who they used to recruit to the trading desk. And so I got this English major, me sitting there. Anyway, it was hard to sort of fathom what was going on, because you would ask the senior or the junior traders and they would mumble. They weren't very good at communicating. One of the things that I had to learn was exactly what you're saying. It was this fallacy that you can't turn every trade into a winner. And in fact, it doesn't matter how many trades as a number you turn into a winner, but where your profits go. Because trading's all about profits. And this leads directly to what you're saying, that psychology and trade management is more important than anything else. How do you convince people of this? Because people approach trading from a technical point of view.
Right.
If I can pick the winner, I'll be cool.
Yes.
And you will be, until the winner goes south.
Right. Well, first of all, I did find a picture of you on the first day on the trading floor, and I want to share that if I can.
I'm afraid of what's coming up, because I had hair then.
Okay, there it
is.
is.
You still got your
as a matter of fact, you did have hair. I can see there's that's not actually.
Except for the glasses, that's not far off.
Okay. So I love your question. How do you convince a brand new entrant into the market, or even an experienced trader who has been enjoying some success over some time? How do you convince somebody that psychology and risk management are going to make more of a difference? And I would argue even that risk management is even more important than psychology, because I've known a lot of demented individuals who were able to make a profit in the market because they had a well-reasoned risk management plan. And I think that my first answer to that is that I try to entertain people long enough to communicate 100 times that those two things are going to make more of a difference. So I did 800 episodes of a radio show across the United States, and or a podcast, and thousands of YouTube videos and whatever else, largely for the purpose of entertaining people long enough to communicate that none of my success in the financial markets has been a result of having figured out the entry. And in fact, the greatest amount of money that I made, the bulk of all my trading profits, Joseph, and I haven't really talked about this until, I don't know, the last couple of years, came in the mid 2000s when I was buying the British pound, Japanese yen, sterling yen, Kiwi yen, Aussie yen in one account at FXCM and Refco, and then selling, shorting it simultaneously and being perfectly hedged in an account at CMS Forex, which was based in New York and run by Russians or whoever else. Yeah. And they gave me an interest-free account. And so I built this magic carry trade, which was basically agnostic as to direction. It was basically gaming the system. And I made a huge amount of money and I got super lucky, but that's the bulk of all the money I ever made in Forex was due to the fact that I didn't care about the direction. I cared about money management and keeping my trades open. And I became like an asset manager. I wasn't like this analyst that was like, and if this squiggly line crosses that squiggly line, and a lot of people would listen to me talk or even read a book that I wrote about it, and they would just be like, that doesn't look like what I'm supposed to be learning, because you're supposed to be sizing up the market and choosing a direction, and then you're supposed to claim that you were right about the direction. And so I just kind of, forever after that, my focus has been on directionally agnostic systems that don't depend on me being smart enough to pick the direction that something is going to go next, because every time I think I figured it out, I absolutely get it completely wrong.
You know, I agree with that completely, because one of the things that I had to learn when I was trading, and I was not the world's greatest trader, was exactly that type of situation, that this is about improving your track record and making money. That's where the bonuses on Wall Street come from.
Right.
Nobody cares downtown how often you've been right.
Right.
They do care very much about how much money you've made. And those two are actually very different things. Do you think it's possible to teach this type of attitude towards people when they come to the market? I mean, it was very hard for me to learn, and I had every incentive to learn it because it was my job. If I didn't learn it, they would fire me. I still can't figure out why they didn't.
Well, having been fired from a financial job, I'm fired, but not survived. You've survived in situations that I never would have. I think it is possible to teach. I think it's difficult, but it is possible to teach it. And I try to communicate a couple of things whether someone's brand new or whether someone's a beginner. I try to communicate that we get into this, and I did in year 2000, 2001. I got into this because I wanted the freedom. And then I realized pretty quickly that success in this industry had nothing to do with freedom. It had to do with constraints and rules. And largely, I thought at first it was rules as to technical analysis, but it was really rules about risk management and not letting a loss get out of control and whatever else. The second thing that I found is that what makes a big difference is the ability to, in some respects, become a little bit of a jerk or have a little bit of an edge to one's personality. And I find that now, so I might know, and you might as well, I probably know thousands and thousands and thousands of traders by their first name. We've both traveled all over the world and spoken at all these conferences and shaken the hands of so many traders and heard from them online and whatever else. And time again, I see this profile of a person interested in doing what you and I do. They're a good person who lost their job or found themselves in a situation where they needed a second income. They've become accustomed to taking care of other people. They generally range between the ages of 35 and 55, and sometimes a little bit older and rarely younger than that. And they have typically in their lives treated people really well, and they're accustomed to taking care of others. And this is a way that they want to do that. And that's a profile of this individual that I come in contact with so many times. They could be a man or a woman or whatever else. The problem is this individual has been a compulsive giver and has not said no to a lot of things. And I see this in myself, and I saw this when I started as well, that I wasn't accustomed to saying no or getting what I want or forcing my way into what I wanted. But if I was going to survive, or you were going to survive on Wall Street or in this profession, you had to be you had to be not a jerk, but you had to be willing at times to be the kind of person that sent your food back, said, this isn't enough. This doesn't fit my criteria. I'm going to be ruthless about preserving my capital, even if it makes me look bad. And I'm going to do these things in order to take care of other people, but I've got to get a little bit of an edge, a little bit of an angry edge. I've got to get a little bit of an ability to say no. And
Right.
and I've noticed that you can teach that. And so what I do is I encourage people to read books about saying no, prioritizing, being ruthless in declining opportunities to waste time or focus. So books like Essentialism, The One Thing, or Jocko Willink's Extreme Ownership, Not Being a Victim, taking personal responsibility for your results, and then ceasing to be embarrassed when we're wrong. It's a huge important aspect of this that I find you can teach that. It takes a while for it to sink in, as it did for me, but you can teach it.
You know, it's interesting because if I was going to put together an analysis, a brief, quick analysis for successful Wall Street traders that I've known, your psychological portrait would work. They come very well. It would be very accurate. They come to it from a different place. They came to it as I did, looking as a job, as a profession. But in order to succeed, that type of, it's almost both being a jerk and humility is necessary. And it's something I've seen a very few traders who had it automatically. I remember guys walking onto the trading floor, but very few of them over 10 years on Wall Street who knew this automatically.
Yeah.
And you have to think about it. I still remember their names because they were so unusual.
I don't know if you found this to be true, but I found this to be true too, is some of the best traders aren't even the smartest people. Like they have they make like tons of spelling mistakes, and they're kind of, I mean, they're kind of spacey sometimes, but they're like the automatically successful people, and they're very far and few between. There's sometimes some of like the most innocent people that are just super genuine about following these risk management rules, but they might not actually know a lot about a lot of things in the market. They might not be a general market technician or fundamentalist or whatever, but they're kind of ruthless in this one small area. One of the best traders I ever met even sounded dumb. Like it just didn't even sound intelligent when he talked to the people, and people would meet him and they'd be like, well, that guy's not successful. And he would wear dirty clothes, just like not the kind of person that you would imagine, but he was ruthless in focusing on what he knew how to do well. And then he just ignored everything else.
You know, one of the things that kept me on Wall Street for a while is there were a number of very fascinating people down there. It attracts all sorts, and it has a very ruthless approach, especially the trading risks. You must be successful. If you're not successful, you will get fired. I mean, that's all there is to it. And the success is phenomenally narrow, but it's very liberating in a sense that you're talking about. But let's, enough about my former career and your former career and all the other guys I used to know downtown. That was a long time ago now. I think on a technical basis, candle charting has probably become the most popular system right now, largely due to the efforts of Steve Nissen, who we know well, and who is actually a very nice and a very thoughtful man when it comes to his approach to this. How do you integrate the various types of both systems, indicators, time frames, all of the things that people will look at as an old term from Wall Street, analysis paralysis.
Right.
You analyze too much or don't think trade. Both of them are true. But how do you integrate in your approach the plethora? I got that from Star Trek last night. Spock uses plethora at some point. My kids and I are watching the old episodes of Star Trek. It's funny, they're only 8. It is great stuff. How do you integrate that for people whom you're talking to about trading?
Well, I have two answers, the short answer and the longer answer, and I'll give you the short answer and then maybe the 2-minute answer. The short answer is 99% of all of my trading now is done robotically and algorithmically. And algorithmically is giving it too much credit. Like, it's a very simple methodology that takes a lot of trades and spreads the risk over a huge number of trades. And no single trade makes or breaks me. And it's just cycling through. I'm trying to benefit from the law of large numbers, which is over time, a coin flip goes 50-50. So over time, a system that I have that has a slight edge in the market should work as long as I give it enough trades. And most of my trading is done mechanically and robotically for the basically express purpose that I wanted to date and get married and have some freedom in my life. And so I switched things over to a robotic system last year. Now,
I know, by the way, congratulations on your marriage.
Thank you very much. You know, marriage, it's apparently easy. I think everybody should do it. I can't believe it. The first few months here, a piece of cake. I can't believe it.
I've
So
been married 15 years. I'm not going to disabuse you of that notion, but it is a good institution and I like it.
okay. So the second answer is I still do some discretionary trading, and anybody who does discretionary trading has basically, if you think about all the books on trading ever written and all the YouTube videos ever published and all the interviews on podcasts and videos ever done, there is virtually a lifetime of material that someone could consume and
Absolutely.
potentially talk themselves out of every single high probability trade with another high probability setup that's being communicated. And so what I've done over the course of my trading career when I have been successful at discretionary trading is act like I'm too stupid to know the difference as far as what to do is concerned and when to get in, and then get really interested after the trade is open. And what I mean by that is yesterday, for example, well, there's a quote in this book. I was actually reading it on an episode of the podcast for tomorrow. And even the most competent of leaders can be overwhelmed if they try to tackle multiple problems or a number of tasks simultaneously. When overwhelmed, fall back on this principle, prioritize and execute. And that's Jocko Willink's extreme ownership. And that's what that's been my recipe for success to the extent that I've had it in discretionary trading. Is yesterday, looking at the Australian dollar, what I like to do when the Australian dollar has an upcoming economic report that evening, US time, is if it's been trending during the day, I look for a short-term chart to show me maybe a slight reversal point, and I'll jump in it. And I have to stop thinking. I have to stop thinking like a trend trader. I have to stop thinking like a fundamentalist. I have to say, people are going to pull out of this, whatever direction it's been going during the day. They're going to pull out, get away from the news before it comes out. And I'm going to take a small piece out of that. And I'm going to stop myself out if it goes above. And every single time, even after 17 years, when I'm about to push that button, there are 1,000 reasons not to do it.
Absolutely.
And there are, even because I do it publicly, there are people telling me not to do it. And I have to get in my bubble, and I have to shut out the world. And I have to understand that, of course, something can go wrong with this. Of course, this could look stupid to someone else, but I have a plan for dealing with this if it goes wrong. And I have to stop thinking, and I have to start doing. And I think oftentimes there's too much thinking and there's not enough doing. Sometimes it's better just be given a trade and say, here's a trade, now deal with it. And yeah. A lot of people can be successful if they're just given a trade, but if they sit in front of a chart, they will talk themselves into the wrong trade, take the trade they didn't plan, or not take the trade they did plan, because they just don't sit down, clear their mind, and do what's right in front of them. And to the extent that I've just done something, I've been more successful.
And one of the traps to fall into, and I used to fall into it certainly when I was trading, more often than not, was attempting too much confirmation. By the time you get your confirmation for 4 different time zones, 4 different time frames, 10 different oscillators, and all sorts of charting systems, the trade's already gone. It's no longer a viable way to make money, so you can't do it.
Yeah, so I always say confirmation is for 6-year-old Catholics. It's just not a. It's not a. It's
Can I quote that trade? Can I quote that?
Yeah, I mean, it's like I just don't. I've seen it gets thrown around. It's a platitude that gets thrown around. Like, wait for confirmation. It's like, listen,
all the time. You
can wait for 25 different layers of confirmation, but it still might not have anything to do with whether your trade is successful.
No, I agree. I want to move on a little bit. We touched on a little bit earlier. As someone who's out in contact with the public, probably more and more successfully than anyone else in this particular business, you are naturally going to get a feel for things that are moving in the wider world.
Okay.
Especially because, as you've noted, one of the reasons people come to you and listen to you is because they actually are viewing this as a way to support people, as to make money. So that's a direct contact with the overall economic and sort of political world.
Yeah.
Did you sense, because there has been an unusual year in Western politics,
right?
Both in Britain, in France, pending in Italy, perhaps in Germany, and certainly here in the United States. Did you get any sense of that, or anything that might have alerted or that you picked up on because I was looking for a sense from, and I didn't sense it either. At one point I wrote, I think right before the election, I said, I think Ms. Clinton is going to win, but Donald Trump has a much greater chance than anyone gives him credit for. That's my one claim to being even marginally right. But did you sense anything underneath changing in the way people are viewing politics?
Yeah, so I've been wrong so many times that we don't have time to discuss them. But last year in March, when I was on the radio, I was on 7 AM business talk radio stations, or 10 at one point in the United States on business talk radio, and I had my own show. And one day on the show, I had been watching Donald Trump respond to something, and it was the first time he had called Hillary crooked Hillary. It was the first time he'd used that phrase, or at least one of the first times I'd ever heard it. And I got on the show, and I don't know, at the time I probably had, I don't know what I had, like 100,000 listeners, or I don't know what it was. And I just said it on the radio. I said, he's going to win. I said, absolutely 100% he's going to win. And my mom called in. My mother called in and said, I'm so glad that you said that. And I was like, I cannot believe my mom is a Trump supporter. Like, I cannot believe my mom said this. And I was absolutely convinced right up until the end, 100% convinced that there was no way to there's no way to compete with someone who is charismatic and chaotic. They just no one. We had never seen it, and that and I just had this. So I doubled down on that, Joseph. Now I got the reaction in the markets to that completely wrong, but I did sense that everyone that lived around me in Arizona, all my neighbors, everybody had it. We all had an acre or 2 acres and animals, and we were living in this pocket of the world where I didn't know one Hillary supporter I didn't know, now you didn't know one Trump supporter living on the East Coast in New York.
Well, I did. I knew my wife.
Okay, great. And I just kind of sat there for a minute and thought to myself, there's something else going on here. Yeah. And so I did. I thought that he would. And then after he got elected, I was like, okay, everybody, just, just buckle in. Because if you think this, even if right now you think this is chaotic or weird, I'm of the opinion that this gets way, way, way more out of control. And
there are going to be 4 more years of it.
Yeah, 4 more months maybe, but yeah.
Also, in a sense, if you could stay a little longer, because this is fascinating, and I'd love to extend it just a little bit if you can. This sort of idea of populism is something which the internet has both facilitated and created, certainly in reference to the financial markets. Right. We all know that before the internet, there was no retail foreign exchange. You could trade futures in Chicago if you met every single standard, but like 3 people did. And none of them made money. So there is a sort of a precursor in technology which has brought about a populist influx into financial markets. Right. Or a popular, let's say popular, since populism tends to be a political term. How do you think this has changed the market up till now? Has it? And what do you see for the future of this type of involvement in the markets? Because that's where we're going. We're already there, but we're going to continue along that line.
Yeah, I don't know, Joseph. I mean, I'm worried about it. I feel like we're being driven by a celebrity culture that preceded the celebrity culture that preceded Donald Trump. That Kim Kardashian could have run for president this time around and had a 30% chance of winning. Like we're just living in this, and it's populism and it's celebrity. And when you combine those 2 things, it's just, where do we go from here? Like, which celebrity is our next president? The Rock or Mark Cuban? Like, we don't even think now. I don't even imagine that there's a politician that stands a chance, given the fact that, so I think that things tend to, this is not a very insightful comment, but trends they go farther and they last longer than we think they can. And we're in the midst of a new trend. Populism is a trend, and it's just like a gold trend or an oil trend, and it will go farther and it will last longer than anybody imagines, all the way into 2020, 2027, like way, way, way out. And this doesn't end quickly. This nationalistic, America first, or, or France first, or Britain first, or whatever seems to be spreading across the globe, North Korea first. I mean, this is not going anywhere, and it doesn't bode well. It doesn't bode well for the financial markets. Populism and financial stability has never gone hand in hand. So, I mean, I'm not into making huge predictions long term, but if things tend to just become a bigger version of themselves, or go farther and faster and accelerate, then we're in a completely different world, where if you think it's weird to have a celebrity as the president, imagine if a celebrity was your senator or your governor. Or, I mean, this is not ending anytime soon. And it's pretty clear, whatever you think of Trump, it's pretty clear that everything's being done differently. Like everything. I can't think of one thing that's being done the same old way.
It's true. The internet permits, in a financial sense, it permits a much wider sort of emotional effect on the markets, because there are so many more, it's magnified. There's so much of an echo chamber out there that when you read, I remember during just before the financial crisis, I had friends down on Wall Street, and when Jean-Claude Trichet came out, I think it was summer of 2007, and said, well, the European banking system has no problems with U.S. subprime loans.
Right.
I had friends down on Wall Street, and I would tell them this because, they weren't following what Jean-Claude Trichet does, and I was writing about it. And so they would say over drinks, what, is he crazy? We've been selling billions of these
garbage
securities to Europe, to all the European banks, which we knew turned out to be true. But the sense of all-pervasive calm out of Europe was because Trichet said it, and then until he changed his mind, it gets magnified over and over and again. So it becomes an acceptable idea, even though there was no analysis behind it and really no truth behind it. That does seem to be a risk, and I agree with you, for the financial markets and probably politics as well. How would you approach that as an educator?
Okay, so what you just said is so brilliant. It's like so imagine it's the Trump effect or the populism effect, or the broad acceptance of subprime loans or whatever. It's like from Jim Collins's book Good to Great. It's like a giant flywheel that if you try to, imagine a giant concrete wheel sitting on an axle on the ground flat. Like pushing that and getting it started is really difficult. Like to get that thing moving to begin with is incredibly difficult. But then once that thing gets going, a small push just keeps it going. And that comment by Trichet is a perfect example of someone just shoving that flywheel a little bit faster. And as it gets momentum, it's harder and harder to stop. And so as an educator, what I like to say is we're back in the time of pronounced volatility and pronounced trends and possible carry trades again, and trends that go longer and last, go farther than you think they can. That if the dollar crashes, we're not talking about, oh man, the dollar yen could get to 108. Like the dollar yen could get to 75, or it could get to 140 again. And we've forgotten what that's like. But you and I remember in the early 2000s, these kinds of things were completely normal, and there could be, 1,000 pip run. And I think we're back in that age. And so as an educator, I try to say, we lived in this golden age of range trading, that you could just basically bounce these things back and forth and nothing ever really broke out. And then Trump got elected, and all of a sudden everything was off to the races, and I got caught in a trade and I dumped it and whatever else. But I think that's the thing to communicate here is you gotta take a lead from reality. Whether you like it or not, you like Trump, you don't like Trump, you want him to be impeached, or you think he's making a mistake, or you think that the real estate bubble is in fact, or that Uber is worth $10, not $100 billion, or whatever you think doesn't really matter. Whatever trend exists is likely to become more pronounced and go farther and faster. And we've seen that in the yen pairs, and we've even seen that with the Australian dollar. Like I'm starting to see this stuff. That populism provides this fuel that pushes that flywheel faster. And Obama, whether you loved him or hated him, or even Merkel, Obama, and who was the last guy in Britain or whatever. It was this, we were being led politically by people that didn't view change as a virtue. And now it's the opposite. And that, I think, creates some really substantial opportunities, but risks if you're hanging on to bad trades. Like we didn't really pay the price for holding on to garbage trades until Brexit and then Trump.
You know, one other question, and then we can end, and I really appreciate you staying over. The U.S. market has, the U.S. retail foreign exchange market, from a firm point of view, has been largely hollowed out over the past 8 years.
Yeah, right.
There's basically one firm left, and that's forex.com, Mark Gallant's old
Right.
firm. I used to trade with Mark Gallant. He was the options trader at Credit Suisse, and I was a spot trader, and he'd come over and ask me for prices. Do you think there's any change brewing in this? It's kind of a speculative question. But I think, you know, forex has always been a bit of an alien institution here in the United States. People aren't accustomed to it the way they were in Europe, from having, you know, 25 different currencies in 3 hours of travel. How would you, I mean, did you think that there's a possibility that we can get another, because originally the business was led by American firms,
right?
Largely, not completely, that we might get a return to that type of potential here in the United States?
Yeah, I remember sitting in a hot tub at the Wynn Las Vegas Hotel in 2004, and the people were in the hot tub together, and they said, "Hey, what do you do for a living?" And I said, I trade currency for a living." They said, "Oh, it must be difficult going to the airport every day." So, and you know, we went from no one knowing about the currency market to everybody knowing about it, and then Dodd-Frank basically exploded. You know, just imploded. It decimated the U.S. market, and I think that there's a chance, and I'll go out on a limb here. I think it's coming back. I think that if what I said is true, I believe it's true, that the populism trends or any kind of political trend tends to go farther and last longer than we think it will, and have wider reaching effects than we imagine. I think it's absolutely 100% possible within the next 18 months that Dodd-Frank gets gutted. It just gets reamed. I mean, it has to come before the midterm elections when Trump gets basically, you know, smacked over the head. But I think that it's possible that gets completely gutted, whether it's even administratively, without even repealing it. I think it's absolutely possible if another Supreme Court justice gets appointed. I mean, there's a lot of different ways that Dodd-Frank gets gutted, and we get a return to maybe not the leverage that we used to have. But we get access to, you know, American-led, run, organized, and regulated brokers again in the United States. I think it's absolutely a possibility, and probably it's a probability, in my opinion.
I mean, it certainly has a job point of view. I'm at the last trade show in New York. I went over to talk to the CFTC people, and they had mentioned this, and they weren't willing to say very much about it. But they did mention that the $20 million bond was something that had been looked at, because that seems to be a CFTC rule. Rob, you stayed over 15 minutes. I thank you very much for this. It has been brilliant. I could stay on for an hour and a half with you, but we all have things to do. Once again, everyone, I'd like to thank Rob Booker for being on the show here today. It's probably one of the best ones we've ever done. Rob, it's been a pleasure, and I hope we see you soon.
It's so nice to be here. Thanks, Joseph. And thanks everyone from FXStreet. And thanks everyone for watching. And I hope I can return the favor sometime, Joseph. Thanks for having me on.
Take care, man.